Cybersecurity stocks have done great over the last 5 years. They have had terrific performance looking across the board from Palo Alto, CrowdStrike, Cloudflare. They've all done really, really well. And these stocks, buying them at the right time, can really reward investors. I wanted to stack rank these cybersecurity companies, look at their stocks, value them, and then tell you which one I think is the best and which one is the worst. What am I going to use is the scorecard to evaluate these companies. First, revenue growth. Who's growing really well? Who's getting more market share? That's an important factor. Second, profitability. Who profits better? Who's making more money? Who's driving more free cash flow? And look at balance sheets. Make sure that they all have good balance sheets, or if there's any suspect balance sheets, we point that out. What I'm trying to arrive at is which one's the best investment right now. It's one thing for a stock to flourish and do great, but what's the future hold? And my opinion will be based on looking forward a year or two. Which one of these stocks would I buy? I don't currently own any of these. I have owned Zscaler in the past. I've owned CrowdStrike and I've owned Palo Alto, but it's been a long time since I've owned Palo Alto. So let's get into it. Let me go through each one and share with you what I'm seeing. Palo Alto has the biggest market cap, and they're in the process of trying to acquire another company, which will make them even bigger. They're $116 billion in market cap and have revenues of 8.87 billion. So investors have to pay probably about 13, 14 times revenue to buy this business. The PE ratio is pretty high at 100, and forward PE is 49. Analysts think there's a discount available on the stock. Year to date, it hasn't been doing all that great. The market is doing really well. The S&P is up about 10% for the year. So Palo Alto is not keeping up with the S&P. There's been moments when the stock's been really low, and more recently, it's been nice and low. Just a week ago, it was at $174 per share. So that looks pretty attractive. Looking at their revenue growth, they continued to grow. Now, they might be the bigger of the bunch, and 13.91% revenue growth is pretty decent. When we look at the quarterly, you actually see a little bit of an acceleration. Their revenue growth from a percentage standpoint going from 12% up to 15.3. That looks really good. Let's take a look at gross profits, free cash flows, and see if they're growing those as well. Gross margins tell me overall how desirable this business is. 73.56 is a very desirable gross margin. That means that their product doesn't take a whole lot to deliver to the next customer. The free cash flow also looks really good, $3 billion. And they've grown it over time from 926 million in 2018 up to 3 billion. Nicely done. That's a really nice growth rate. And they should continue to grow that free cash flow to keep their valuation high. You've seen the pullback in 2025, and it may be that they're not growing their free cash flow. We'll take a closer look. So the margins I really like. I like their top line growth, and I like their free cash flow. Let me show you what analysts are saying about Palo Alto, and we'll also take a look at the balance sheet. So we've got 39 analysts weighing in on Palo Alto. The highest price target is 235. Lowest one is 130. Consensus is the stock's discounted by about 21%. They expect that this company is going to continue to grow mid-teens. That looks really good. Growing at 14 to 17 over the next couple of years. That is pretty attractive. And earnings per share looks good. It's going to grow a little bit faster than earnings per share. So this looks really good. And I'll use this as I value the company. The balance sheet. I'm going to guess that all these companies have good balance sheets, but I don't want to just guess at things. I want to make sure that I'm seeing good balance sheets. And in the case of Palo Alto, it is a good balance sheet. $3.3 billion, only $806 million of debt. So they can pay off debt very quickly by writing a check. And they have net cash of $2.49 billion. That looks really good. Now let me show you my valuation of Palo Alto. Palo Alto offers about a 9% discount. And I arrived there by looking at the value of the business based on the free cash flows they're going to drive and growing those cash flows in the first 4 years by 15%, and then the terminal value growing it by 5%. These guys are in a good, fertile market. Cybersecurity is going to be a big necessity for companies for a long time. I add cash and take away debt to get to an equity value. So, based on cash flows, the stock is discounted by 18%. This year, the stock hasn't done all that great. So, there is a discount available on Palo Alto. The earnings per share is $3.75. I'm giving them a generous 36 PE. They are growing mid teens, which is good. They have good margins. And I'm growing that earnings per share by 10%. So when I use those particular metrics, I get a 15% premium on the stock. I think the market's paying up for cybersecurity. They're paying up for the stock based on earnings per share. So a 9% discount on Palo Alto. Not the most compelling discount. Palo Alto is a desirable business. Let me think about this one. I'll scorecard all the stocks together and kind of arrive at which one looks the best at the end of the video. CrowdStrike has made a lot of headlines over the last 18 months. One of the biggest headlines they made was when they literally made the world crash, when they had a bad update to their software. That was really embarrassing for them. I'm glad that hasn't happened again for the sake of the planet. Now, this company, their market cap is $105 billion, almost the same amount as Palo Alto, but the company is about half the size of Palo Alto. That's something to point out. Forward P is 110. Their current year doesn't have a P because they're not making a profit this year. Analysts think there's a small discount available. Year to date, the stock's up 24%. And that's pretty decent. That is beating the S&P. When we look at their growth rate, the growth rate is better than Palo Alto's, 26% versus about 15, 16%. But again, Palo Alto is twice as big. So when you grow 8 billion by 15%, you're adding about 1.2 billion of revenue, where when you grow 4 billion by about 25%, you're adding about 1 billion of revenue, about the same revenue add to the top line, but Palo Alto is bigger to begin with. Not to get too mixed up in the numbers, these are good numbers. They are decelerating their growth rate as they get bigger. Competition is heating up in the space, and they have to compete with more and more players as they become bigger, competing against Palo Alto, Microsoft, Google has a solution, even Amazon has cybersecurity services. So CrowdStrike and the rest of these guys, they have competition. It's not like they're left alone to do whatever they want. They have some pretty stiff competition. So 26% looks pretty good on the top line revenue. It shows that people like CrowdStrike software and more customers are taking it. Now we're dealing with free cash flow, I'll call it 1.1 billion. Palo Alto is at 3 billion. So Palo Alto has 3 times the cash flow. And again, their market caps are nearly the same. Gross margins, 74.48, about identical with Palo Alto. So these companies have similar characteristics, but you could start beginning to see some differences in the valuation of the companies. CrowdStrike gets a lot of benefits to this higher growth rate. Let's see what analysts are saying about the company. We've got 44 analysts covering this stock. The highest price target's $555 per share. The lowest at $275. Wow, that's pretty low. And consensus is that the stock is discounted by 8.47%. As we look at growth rates, these guys are expected to grow by this fiscal year that they're in ends January 31st of 2026, and then they'll start a new fiscal year. The fiscal year that comes is going to grow at 21.83%, then 23 looks good. I'm going to use the earnings per share that we are in the current year at $3.59 in my valuation. The PEs are a little bit high. They're a little bit elevated. I think CrowdStrike is kind of a quite popular stock, but it's not perfect. I think it's a little bit priced with a little bit of a premium. I valued CrowdStrike and I come up with a stock that is 42% too high. The price that I come up with as a value for the company is $244 per share, but the company is priced on the marketplace for $423 per share, representing a 42% premium. Based on cash flows, the cash flows for CrowdStrike are substantially lower than Palo Alto. Palo Alto is about $3 billion, and this one's at $296 billion for the first 12 months. I'm growing cash flows by 25%, just like their growth rate tells me on the company, and long-term growth by 5%. So the cash flows add up to being worth 32% less than their current stock price. The earnings per share is even more drastic of a premium. I use their earnings per share. I give them a P of 36. They are growing at 25%, which is good. Now, again, I compared them to Palo Alto, same type of business. Palo Alto's growing faster if you measure by dollars. CrowdStrike has a higher percentage because they're smaller. So I'm going to use the same PE as I look at both stocks. And when I do that, this one reveals a 62% premium. Combined, it's a 42% premium. So CrowdStrike's priced rather expensive. If their growth rate on their revenue ever decreases more than expected, let's say it hit 15% revenue growth in a quarter or two, I would expect this stock's really going to sell off because investors are hanging on the fact that this is a high growth stock. But I would argue that it is a growth stock, but I think over time it's just going to become like the rest, just a moderate growth stock. Cloudflare is the next company. They're about a $68 billion market cap company with just $1.88 billion of revenue. You think about that, you're paying about 30 times revenue. That is looking expensive. The stock is really flourishing, 81% in the year to date. Wow, that's pretty impressive. The forward P is 195. Wow, it looks expensive. And the price target that analysts have a consensus on is 6.43% below its current stock price. When we look at this stock, the headlines are beginning to doubt the valuation. There's stories being written that this might be a meme-like stock. Just in passing, I would put that out there. They are growing nicely, 27%, around the same rate as CrowdStrike. They are a little bigger than CrowdStrike. Their revenue is a little higher. So that is impressive that they're growing at that level. Now, what is not impressive is their free cash flows are terrible. Again, I just showed you two companies that are similar to this business, one producing more than $3 billion, another one producing well over $1 billion. And these guys are at $208 million. And again, their revenue is more than CrowdStrike, but CrowdStrike's doing almost $1 billion more free cash flow. And free cash flow is the principal valuation that I use. It's also the principal valuation that Charlie Munger and other investors have used for many, many years. So based on the fact that these guys don't produce a whole lot of cash flow, I don't even track this company because the valuation is so darn low. The best I can do is get maybe to $8 to $10 billion of value, and that just really doesn't come close to the market cap. So this one here is a little bit of a dead-on arrival situation based on that cash flow. The gross margins look good, but how does a company making that kind of revenue just consistently lose money? It's either being mismanaged, there's something there that just is unrelatable or undefined, and it's just a little too much of a mystery. When we look at what analysts are thinking, 28 analysts cover it, and there are some analysts that are skeptical. $65 price target is what I'm pointing at. And there are analysts that are very optimistic as well at $250. Now, these valuations and earnings per shares are based on earnings per share. Now, the earnings per share is far lower than CrowdStrike and Palo Alto. And again, how could they be, I guess, burning so much money in the expenses line? They're much bigger than CrowdStrike, but they don't have a lot of profit come down to the bottom line. So this one here, I don't even do a valuation on Cloudflare. It's just an undesirable business in my book. Fortinet is the next stock up based on market cap. Market cap for this company is $59.34 billion, revenue $6.34 billion. And the PE looks a little normal, which looks pretty attractive at 30.88 and 29.91. Price targets are 24% higher. When we look at the year to date, this stock has been sold off 18%. Over the 5-year, this is a winner, up 204%. Over the 1 year, up 8%. I like catching stocks that are discounted. I'll tell you which stock later I bought and made some money on because I bought it at the right time. I like seeing situations like this. Let's see if this stock is setting up to be a pretty decent investment. The revenue is $6.3 billion. This is larger than CrowdStrike. And this is larger than Cloudflare. And they grow at 15%, which is about the same as Palo Alto. But Palo Alto was at about 8.2 billion in top line revenue. So it's a good growth rate, but not quite as good as Palo Alto because Palo Alto has a bigger number that they're growing. They do have really good gross profit. And they have terrific free cash flow. $2 billion of free cash, loading that balance sheet with that beautiful cash. And their margins are better than any of the companies that I've covered to this point. Better than Palo Alto, better than CrowdStrike, 81.29. I'm impressed. Operating margins 30%, profit margin 30%, free cash flow margin 32%. Sign me up. If the bank wanted to pay me 32% yield on my money, boy, I'd have to put a lot of money in that bank. The balance sheet looks terrific. Lots of cash, very little debt, and I'll show that to you later. Some analysts are really optimistic on this stock with a price target of $130 per share. Worst case scenario is 75. Well, that's not too bad. We're at $77.47. So the price target's consensus is 24% higher than what we're doing, where the stock is today. When we look at growth, this company is going to grow similar percentages as Palo Alto, and their profits are going to grow about the same amount. So I'm going to use their profits from the 2026 year, $2.88 to value the company. Fortinet, when I value the company on cash flows and earnings per share, is discounted by 37%. I guess that pullback on the stock price is offering up a pretty nice discount on a solid business. This business is similar to the businesses I just covered. Margins are actually better. Free cash flow looks excellent. So 37% discount on Fortinet is really compelling. And I'm thinking I might buy some shares of this stock today because I don't own a cybersecurity stock. I thought that they were priced a little too expensive for a little while. And I'll tell you which one I owned in a little bit and made money on. But this one's looking good. I'll wait till the end of the video to tell you which one looks the best and which one I'm going to buy. Zscaler is the next stock. I'm very familiar with this stock because I owned it and I made some money on Zscaler. Year to date, it's up 50%. Nicely done, Zscaler. This stock here provided investors a nice discount. You could see that when we were looking at this stock a couple of years ago, boy, it looked really good and their fundamentals were solid. So if you're patient, the market will offer up nice discounts on stocks. And I took Zscaler for a ride and made some money. I'm currently not an investor in Zscaler. I've sold my shares. Let's get back into looking at their fundamentals. They're a $42 billion business, $2.55 billion in revenue. So you're paying about 20 times revenue for the company. Their forward PE is a little high at 78. Analysts think it's discounted about 9.5%. We look at their financials, they look pretty solid. 25% growth rate on a revenue number that is higher than CrowdStrike, but they have the same growth percentage. So again, I'm going to pick on CrowdStrike because they should be picked on. They're half the revenue size, but 25% growth rate matches CrowdStrike. This is one of the reasons why I bought CrowdStrike. They were growing really well, really showing great growth. They really expanded their business. So when we look at their free cash flow rate and gross margins, they produce really good free cash flow, $771 million. Not quite as good as CrowdStrike, by the way. CrowdStrike is better there. Good margins, 77.46. All the margins of the companies we've seen have been really good. So this company here, I valued based on cash flows and earnings per share. Let's take a peek at what analysts are thinking of Zscaler. So Zscaler, the most optimistic price target, 385. The worst case scenario, 170. That is kind of a lot of downside risk there. When we look at their earnings per share, it's expanding nicely. They're going to be profitable and stay profitable. Really, really looking good. And they are in the year that ended July 31st, 2025. I'm going to use the year that will end July 31st, 2026, which is $3.77. I'm going to give them the same PE as I'm giving all the companies. I'm going to keep it fair. That way we know where are we getting the best deal. We're shopping for a good cybersecurity stock. I'm keeping the PEs the same. So 377 is going to be the earnings per share I'm going to use on their value. Zscaler is no longer discounted. That horse has left the barn. The money that could have been made on Zscaler may have expired. The stock is priced 24% too high. The cash flows look good, but they can't add up to the current market cap. And when we look at the earnings per share using a PE of 36, just like everybody else got a PE of 36, we get a price that is 42% too high compared to the value of that profit. So combined, this stock is priced 24% too high. When it got above its intrinsic value, I cashed out of Zscaler. And I'm glad I did, because I think the company did what I thought it was going to do. I made money, and I moved on. So Zscaler, thank you for the money I made, but now it is priced too high. And the final company I'm going to look at is SentinelOne. They have a market cap of $5.5 billion. They're the smallest market cap that I'm looking at. And the revenue is $864 million. Net income, they're losing money, and they have a forward P of 69.88. Analysts think they could go up 49%. Again, they only look at earnings per share. They don't look at cash flows. Year to date, this stock is really sold off. Is it an opportunity? For the 1 year, down. For the 5 year, down. Oh, man. When we look at their revenue, they are the smallest revenue company I'm looking at. They're growing at 28%. That is very good. That is very good. But it's a small number. And I think CrowdStrike was mid 20s, and another one of the companies we looked at was mid 20s, but their revenue was much higher. When we look at the free cash flow, it's only 42.88. And whenever I've valued SentinelOne, I've had a hard time getting their valuation higher. It's a little bit like Cloudflare. How is this cash flow so low when you have a gross margin that's so high? Based on this cash flow, I would really have to be very generous to get them to a $2 billion valuation based on cash flow. And the current market cap is 5.5. So their lack of cash flow spoils the recipe for this stock being a stock that I would even consider. Cash flows are way too low. The forecast is really based on earnings per share, and some analysts have really high hopes for the stock with the price target of $33, and the worst case scenario is 17. Again, this is all based just on earnings per share. And the earnings per share are supposed to get into the profitable zone, but they're pretty low on profits. I mean, you have to use a pretty high PE to establish year one. This is the year that's going to end January 31st. So it's just a little too high hopes and not enough fundamental valuation for me to be an investor. I am out on SentinelOne. This is not a desirable company for me. So in conclusion, what's the best stock for me to invest in and the worst stock for me to invest in? The winner of this comparison is Fortinet. Reason for it is they have excellent revenue growth, showing that customers want their software. They have excellent free cash flows, showing that they're loading up that balance sheet and loading up the balance sheet for investors. They have the best gross margins, and they have the best discount based on free cash flows and based on earnings per share. The stock sold off, so the market is offering a nice discount. In second place is Palo Alto. It offers a little discount, a teaser discount. But if you like Palo Alto, believe in the business, can't argue with buying Palo Alto. It's got a decent discount. I think it's going to grow over time. In third place is probably Zscaler. Zscaler is priced a little too high now by about 24%. It's a good company. All these companies are growing, which is something about the space. And then CrowdStrike is in fourth place. I think they're priced too high, but they are a very good company. The fifth place company is going to be SentinelOne, because they are the smallest. They have a lot of potential for the upside. And the worst investment for me is Cloudflare. I don't like saying anything bad about companies, but just they have really run up. Their stock price has really gone up, and their fundamentals are terrible when it comes to free cash flow. So I just need to call it like I see it. The free cash flow just isn't worth the stock. So just in conclusion, in the middle of this video, I bought Fortinet stock, and I am now a stockholder of Fortinet. It's good to compare all these companies. Obviously, they all compete against one another. You're able to see which one is the best opportunity for the investor when you go through this process. I hope you found this interesting, and I'd love to see your comments on these companies.